Right now, there are people watching this video who think they're being smart. They found a stock paying 12%, 13%, even 15% in dividends. They did the math. They're excited. They think they've cracked the code, and they are about to get absolutely wiped out. And I'm not being dramatic. I went from bankruptcy in 2007 to building multiple seven-figure businesses, and I have made exactly this mistake, chasing a fat yield on a dying company. And you know what I got? A dividend cut, share price that collapsed, and years of gains gone in months. And what I'm about to show you are 7 real companies and funds that are paying high yields in 2026 right now, that are quietly running what I call a capital treadmill. And you're collecting dividends on one end while the company destroys your principal on the other. You stay in long enough, you end up worse than when you started. And by the end of this video, you're going to know exactly what to look for, exactly which names to avoid, and most importantly, how to tell a real dividend from a yield trap before it costs you. Let's get into it. Before I give you the 7 names, you need to understand the trap itself, because the middle class mindset sees a 13% yield and thinks bargain. The wealth builder sees a 13% yield and immediately asks, why is it that high? And here's the rule. In a healthy market, a yield above 8 or 9% is almost always a warning sign, not a gift. That yield is high for one reason. The stock price has already collapsed because smart money has already left the building. The math that kills people is this. You buy a stock at $20, paying $2 a year in dividends. That's a 10% yield. Looks great, but over the next 12 months, the company struggles, cuts the dividend in half, and the share price drops to $12. You collected $1 before the cut, but you lost $8 in principal. You just lost 7 years of dividends in 1 year. That's the capital treadmill. Walking hard, going nowhere, or worse, going backwards. 3 red flags that scream yield trap in 2026. 1, payout ratio above 100%, meaning the company is paying out more than it earns, funding dividends with debt. 2, exposure to the private credit collapse, especially in software sector loans. 3, a dividend safety score below 20, which analysts classify as very unsafe. Keep those 3 filters in your head as I walk through the 7. And the first one on this list already slashed its dividend by 92%. Let that number sink in, 92%. Trap number 1, Ready Capital, ticker RC. This was a mortgage REIT that income investors love. High yield, real estate exposure, looked rock solid. Then, higher interest rates crushed their multifamily lending business. Rent growth slowed, and the whole thing imploded. The dividend was slashed by 92%, not 10%, not 20%, 92%. Investors who were chasing that yield didn't just miss the income, they watched the share price collapse alongside it. That is the textbook wipeout. RC currently carries a dividend safety score of 15. That's very unsafe territory, and the market has already priced in more pain. Trap number 2, Golub Capital BDC, ticker GBDC. This one matters because Golub is a bellwether. When Golub moves, the whole BDC sector watches, and what Golub just did is not good. They cut their quarterly dividend by 15%, from 39 cents to 33 cents. Why? Their payout ratio is sitting at 101% of earnings. They are literally paying out more than they make. Here's the underlying problem. Golub has 26% of its portfolio in software sector loans. And in 2026, AI is gutting software revenue everywhere. Enterprise companies are slashing software seats. The SaaS loans that BDCs like Golub made at 25 to 30 times EBITDA are now going bad. This isn't a hiccup. This is structural. But here's what's wild. The next trap looks completely safe on the surface. Consumer staples, the sector I recommended in my recession-proofing video. Even there, a yield trap is hiding in plain sight. Trap number 3, Prospect Capital, ticker PSEC. Analysts have flat out labeled this one a red flag. The net asset value, the actual underlying worth of their loan portfolio, keeps eroding quarter after quarter. Non-accrual loans, meaning loans that have stopped paying interest, rose to 0.7% of total assets in early 2026. When borrowers stop paying a BDC, the BDC stops paying you. PSEC is a primary candidate for principal loss this year. Avoid it. Trap number 4, B&G Foods, ticker BGS. This is the sneaky one. Consumer staples are supposed to be boring and safe. B&G sells real brands, shelf-stable food products you've seen in grocery stores. But here's the brutal truth. Their free cash flow is flat compared to 10 years ago, a decade of zero growth. They haven't expanded market share. They haven't improved margins. The high yield exists because the share price has been slowly bleeding for years. This is what I call the value trap with a label. It looks like a safe dividend, and it's actually a stagnant business slowly paying you back your own money. Trap number 5, Monroe Capital, ticker MRCC. Monroe got downgraded to 19, very unsafe after cutting their dividend by 28% in late 2025. They are now in a desperate pivot, planning a merger and selling assets just to preserve whatever capital is left. And when a company's exit strategy is selling itself, the dividend is not your friend. All right, we've got 2 more, and the last one might surprise you because it's not a single stock. It's an ETF, and a lot of people think ETFs automatically mean safety. They don't. Trap number 6, Greystone Housing, ticker GHI. Greystone cut its distribution by 17% after exiting several apartment equity investments, now rated 21, unsafe. Here's the pattern you need to recognize. A dividend cut is rarely a one-time event. It's almost always the first domino. Companies cut once, stabilize for a quarter, then cut again as the underlying problem continues. GHI fits that pattern exactly. Trap number 7, the BIZD ETF. This is the one that catches the most people off guard. BIZD is the Van Eck BDC Income ETF. It's supposed to give you diversified BDC exposure, 13% yield. Sounds like the smart way to play high-yield BDCs without picking individual names. The problem? You're not diversifying away from the risk. You're concentrating it. The entire BDC sector is under pressure right now. Private credit firms like BlackRock and Blackstone are facing record redemption requests. The price-to-book ratio for BDCs has dropped to 0.83x. The market is pricing in a full default cycle in direct lending. That 13% yield on BIZD doesn't reflect an opportunity. It reflects the market expecting more pain ahead. An ETF can absolutely be a yield trap when the entire sector it holds is in structural decline. So what do you actually do with all of this? Here's your 3-question checklist before you touch any high-yield investment in 2026. Question 1, is the payout ratio above 80%? Above 80 gets a yellow flag. Above 100% is a hard no. Companies like State Street with a 33% payout ratio, that's a company with room to raise dividends for a decade. Companies paying out 101% of earnings are robbing Peter to pay Paul. Question 2, does this company have software sector loan exposure, private credit exposure, or debt coming due in 2026? If yes, dig deeper before you touch it. The BDC maturity wall this year is $12.7 billion. That's not a small problem. Question 3, what is the dividend safety score? Scores of 81 to 100 are very safe. Below 20 is very unsafe. The companies on today's list are sitting between 15 and 21. You want 60 and above as a minimum for your core dividend holdings. Boring companies with 30% payout ratios and 25 consecutive years of dividend increases, that's the snowball. Exciting companies with 13% yields and eroding NAVs, that's the treadmill. Now look, I'm not here to scare you away from dividend investing. The dividend snowball, $500 a month into quality names, is still one of the most powerful wealth building tools available to regular people in 2026. I did an entire breakdown of that strategy in the last video. But the snowball only works if you avoid the traps. One yield trap in your portfolio can cancel out years of dividends from your other holdings. That is not a math error wrapped in bad luck. That is a middle-class mindset decision, chasing the number without reading the business underneath it. The 7 names I gave you today, Ready Capital, Golub Capital, Prospect Capital, B&G Foods, Monroe Capital, Greystone Housing, and BIZD, write them down. Put them on your do not buy list for 2026. If you want to see exactly which dividend ETFs I'm buying right now to build the snowball safely, that breakdown is in the next video. Hit subscribe and turn on notifications so you catch it. And if this opened your eyes to something you almost missed, smash that like button. It gets this in front of people who need to hear it before they make an expensive mistake. Stay disciplined, stay boring where it counts. Wealth is built by not losing money on stupid bets. Peace be with you. See you in the next one.